Hi, I'm Bryan Shaffer from George Smith Partners. I want to welcome you to Finance Friday. This is a very special edition as we're coming to the end, hopefully, of the COVID period. And we want to welcome everybody. Today, I'm here with David Pascale.
Hello.
I'm Bryan Shaffer. I'm a partner here. I've been George Smith Partners 10 years. I've been in the industry almost 30 years. And we wanted to do something really different today. What we wanted to do is give you a glimpse inside George Smith Partners. Every Tuesday for the last 10 years, I've been going to staff meetings and we talk about what's happening in the world and what economic events are going to affect capital markets and commercial real estate. And part of that is always David. And for me, that's the most important part of every week. I sort of get my fundamentals of what's happening in the world, and it makes me think of everything so I can help my clients better. So as we've done these series every month, we've brought in experts from around the industry. And today we wanted to share some of our in-house expertise. David and I wanted to talk about the economy and give you an idea of what's going to happen with interest rates, what's happening in the world. You know, there's all these headlines about inflation and problems. And what we really wanted to do is focus in and tell everybody what our view is and how we think that's going to impact capital markets. So first of all, my guest, David Pascale, I call him our CEO. He's our chief economic officer. He's our in-house accountant. He's the smartest guy I know on anything economics. You could wake up at 5 a.m. and say, why are rates down? If you call David, he'll have an answer for you. So David, today we see the breaking news headline, retail sales. What do you think of that? How is that going to impact us?
Hello and welcome to Finance Fridays. I'm happy to join everyone. And I'd also like to open by saying that Bryan and I are also going to discuss in detail all of the product types in commercial real estate, speaking to our sponsors and what sponsors should be looking for right now at where we are in the cycle, if you're trying to prepare your property for financing or if you're looking to buy anything. But so responding to Bryan's question, we're talking about this morning retail sales. Retail sales were flat when we have all this stimulus and we're in this rocket ship recovery supposedly, and we had flat retail sales after a very hot CPI report this week that got a lot of attention. And this is coming on the heels of this month's jobs report, which was very unexpectedly low and tame. And so I would put it into some perspective as saying we're in absolutely uncharted territory. We've had recoveries and recessions for many, over the cycles, going back to, call it the post-World War II economy many times. But this is a unique recovery and unique point in the cycle because the United States and the world completely shut itself down economically about 1.25 years ago and is now coming out into kind of an asymmetrical recovery that won't be like other recoveries. So, again, that uncharted territory and the uncertainty gives it a lot of interest. And I think the retail sales report is part of that story.
David, do you think that, and obviously retail sales point to less inflation. Do you think, this last week, every client's called me and said, inflation's coming, are rates going up? What's going to happen? What do you think the big picture is? How does inflation impact us right now?
Right. So the, inflation is worrisome to markets and investors because if inflation runs too hot, our Federal Reserve Bank will have to raise interest rates in order to combat the inflation. And the question right now is the Fed going to raise rates, or are markets going to sell off in treasuries even if the Fed does nothing because of the fear of inflation? And I think the main question that everyone is asking is the T word, and it's a masterful piece of Fed speak, is they are calling the inflation that we are seeing, because we are seeing inflation in the last month especially, and we will in the next few months, transitory. And the question is it transitory or is it real? And when we get that answer, if it is real and sustained, then the Fed will raise rates sooner than later. If it's transitory, then the Fed has made it clear that they will ride out the transitory period and then see where we are at the end of that period.
No, that's really interesting. And I know you put together this chart on the Fed and the road to normal. As you look at it today, what's your gut telling you? I mean, are we in a place where we're going to see in the next year higher rates? I mean, the Fed has sort of signaled that they're going to do everything possible to keep rates where they are. Do you think that's going to happen, or do you think the natural economy and all the heat coming from the economy is going to push us in a different direction?
I want to go back to the previous slide for 1 second. Back one more. Back one more. Sorry. So when we're talking about inflation, I wanted to show this slide. The green line is average hourly earnings, and the CPI and PPI are prices. They are trending up, but the Fed has almost has an altruistic and a rising tide lifts all boats attitude about this. They want to see the average American's lot in life improve and share in the recovery. And that is expressed, since most of America working is our wage earners, and average hourly earnings, as you can see, have dipped down. So until they start trending up, I don't think the Fed will feel that it's time to raise interest rates. Now, that being said, and we can move back to the slide, the Fed slide, thank you, is that just yesterday, we heard some very increased signs of wage inflation. McDonald's, Amazon, and Marriott, three absolute, blue collar, mid-level job providers on a national scale, and Chipotle also, all announced within 48 hours, and this is just from last night, that they will be raising wages. Now, again, is this transitory? Because we still have some workers that are a little shell-shocked from the pandemic. We have workers still collecting federally enhanced unemployment till September. And we also have kind of another asymmetrical demand situation where certain sectors, like, for example, fuel truck drivers, are in absolute shortage. This is a highly qualified, specialized job. So they are almost doubling the wages for that group. My point is that there are some inefficiencies in the economy, the stimulus overhang that I mentioned, the demand issues, just the fact that kids won't be back in school now till September, and a lot of parents are just staying out of the job market and continuing to take care of the kids at home until September. So these anomalies may work, and we have also supply chain inefficiencies. So these anomalies may work themselves out over the next 3 months. I think the next 3 months are critical.
Yeah, no, that's really interesting. And it's funny because I tell everybody, everybody comes to me and says, inflation's happening, rates are going to go up. And I always say, the biggest component of inflation is wages, and wages are not increasing. But now we're starting to see little signs, as you said. So from a big picture standpoint, I just want everybody to realize this is really important, because if wages continue to rise, that means that we really will have inflation. If it's transitory, as you said, then we won't likely have inflation. So I think everybody should really watch these wage numbers as we go forward. David, so how does this correlate with interest rates? As you can see from the slide we have, the Fed is, in new uncharted territory. I mean, we've never been in a global pandemic. We had the 2008 crisis that was more of a financial crisis. This is more of a black swan where, this event happened and disrupted everything in the world. And I was just watching the news earlier today, and there were people saying everything's coming back. There's not going to be hotel rooms, there's not going to be travel. We're going to be in a whole new dynamic. But the numbers haven't really ferreted that out. They've been sort of mixed, as you said, as you pointed out. So where do we go from here? What's the Fed going to do, and how is this all going to impact interest rates?
So when we talk about the Fed, and I want to talk about the most basic thing is, some might think that the Fed has a lever on all interest rates. So our borrowers out there, I'm speaking to our sponsors, you're either borrowing a floating rate loan or a fixed rate loan. The floating rate loan is LIBOR based, so we're watching the indices. The floating rate loan is based on LIBOR, and in a couple of years, it'll change over to something called SOFR. That's a whole nother Finance Fridays, just talking about that. And then if you're a fixed rate borrower, whether it's Fannie or Freddie, CMBS, Life, and remember, this fixed rate borrower is borrowing for 10 years. So month by month volatility in the 10-year can set their property up for either 10 years of great income or not so great, depending on the vagaries of the Treasury that particular week. So the Fed has an absolute hand on the lever of floating rates. LIBOR, unless there's a credit crisis, moves in lockstep with the Fed funds rate. Right now, LIBOR is about 0.15. The Fed funds rate is at 0. And when the Fed funds rate is at 0, that's the target rate. It's really 0 to 0.25. So right now, today, the Fed funds rate is 0, which it was put at 0 in mid-March 2020 on that famous day that Jerome Powell came on the screen on a Sunday and said, I'm lowering rates from 2.5% to 0 tomorrow morning. And the stock market immediately crashed, and that's when the shutdown started. And they've been also doing quantitative easing, purchasing $120 billion of bonds per month. In that way, these bond purchases affect the fixed rate because they are buying treasuries and mortgage-backed securities that affect credit spreads on Fannie and Freddie loans, and kind of also follow, other credit spreads will follow that because Fannie and Freddie are an industry leader. So what's next? So I was reading William Dudley, an ex Fed governor, had a great think piece that I was reading the other day, and he reminds everyone of the steps. The first thing that will happen is the Fed will talk about tapering the bond purchases, preparing markets. Powell has talked about this extensively, and what he's trying to avoid is the famous summer 2013 taper tantrum when bond yields went up 160 basis points in a matter of months because Bernanke kind of fumbled his answer to and announce preemptively surprise markets about tapering the bond purchases. So we expect that to happen in summer 2021. A lot of people are pointing to the Jackson Hole giant symposium, the annual symposium, where the Fed often rolls out big policy changes. Then they will start decreasing the monthly purchases. Now, this will, remember, put more bonds, take a big bond buyer out of the market. So the private sector, the regular bond buyers out there, the banks and the regular investors will have to either pick up the slack or yields will rise. So, and only after decreasing the monthly purchases for a while will it actually raise the Fed funds rate. The Fed has said no increase until 2023. The Fed futures market just last week, this is more kind of breaking news, is now pricing in an increase, especially after the CPI report this week, in late 2022. And that's when floating rates will start to rise. And then, so just some perspective on the zero rate, in the summer of 2006, which is the last normal we knew, because all the way from the financial crisis to today, rates have been, artificially low as the central banks have been in recovery mode. It was 5%. Could we even imagine it going to 5% now? From 2018 to 2017, it was 0. and it raised to about 2.5%. So, that is what people should be watching the Fed for. And keep in mind that your fixed rate is market driven and your floating rate is Fed driven.
No, David, that's great information. And, I always tell clients that, rates are really a perspective because, some clients, strive for these really super low rates and they lock them in for some long period of time just to be shocked by some change that happens in the world. Mm-hmm. And so, I look at, 2018, that was sort of the pivotal time where, the Trump tax cuts were kicking in, the economy looked like it was taking off and exploding. And I had so many clients come to me, I want 15-year money, I want to lock in right now. And a lot of guys locked in between 4.5% and 5%. And now are so miserable that they did it. Do you think we're ever going to get back to that environment where we're seeing 5% rates, or do you think the new normal is lower rates under 3 to 5%?
It really depends on inflation, and maybe let's go to the spreads slide. I think was that next. Let's go to let's see. Okay, so this is a really interesting slide. This is 2007 to today, average 65% loan to value, commercial and multi spread, spreads over treasuries. And you'll look, they spiked in 08 during the credit crisis, but look at how consistent they've been in the 150 to 250 range. Of course, they peaked up, as you see last year during the initial pandemic crisis, but they're coming straight back down. So it really tells me here that if spreads are fairly consistent, then it's really all about the index. And if treasuries, let's look at where treasuries are now. I mean, I'll just say is we were at a 90 treasury. Let's go back there. No, there. So, at the beginning of the year, we were at the treasury was 90 all of last year, and that was pandemic relief, panic in the markets, flight to safety. Now that the markets are opening up, the treasuries have gone up 70 basis points, back to about, as high as 170 this week. And remember, what was the last normal? And normal is such a fungible word since the credit crisis of 08, but they were in the 180 to 170, 180, 190 range for much of 2018, 2019, what you're talking about. So I think the next key element is, call it 2% treasury, which puts us to a 4% coupon. I could easily see the treasury going to 3% and spreads being in the 150 to 250 range, meaning 450 to 550 rates. But I would also add that if that was happening, we're going to be in a high growth economy. The only, panic there is the specter of something called stagflation, which I really don't see coming because there's still so much downward pressure on rates, is, where we have a stagnant economy and inflation. But, in a way, commercial owners should be welcoming growth and maybe, having to live with the higher rates that come with that growth, because it means our economy is doing well.
Yeah, no, that's interesting. And I guess I'm still of the opinion that I don't think we get really much higher than 3. And I actually, my view is we stay between 2 and 3 in the long term, but I know everybody has their own views. Let's move on to reopening and some key dates. So what do you see as the key date to actually the economy reopening? When are we going to know if we're open and everybody's successful and if the numbers we're seeing are real?
Right. So, I think there's some interesting dates coming up, now, like just this week, more breaking news, the Biden administration announced and the CDC, the end of, what we call masks all the time. Now, still, immediately you saw stores like Starbucks and Macy's said, when you go in, you're still going to have to wear masks, but it's still a significant day. People feel that they can take the mask off. It's a psychological, that it's safe to take the mask off. And that's, what we're being told. And so that's critical. I think, again, this summer, you're going to start to see sporting events and concerts, which, a lot of people will be watching on TV and seeing people gather. Those will be significant. And then I think also very significant is September. And I'll talk a little bit about why I'm so focused on September Labor Day. One reason is that's when the office market is expected to be either come back in the office, or the shakeout will occur or begin to occur on working from home. And we'll get into that a little later when we talk about office. But also, supposedly from preschool to college, you are going to have schools open for in-person learning. There's been a lot of thought out there that kids, especially young kids, need to be physically in school, that they've already, there's mental health issues or burnout from being at home from the parents, that it's critical. Then all those working parents will then be free to do the things during the day, shop, go to the office, and you'll see just like the shakeout of where we're at. And I think it's also significant that, America's favorite sport is football by far, and that both the NFL and the NCAA are saying we are expecting full stadiums. So just people seeing stadiums full of people and hopefully no COVID spikes should be another huge psychological barrier. And the last thing I want to bring up about the summer is, by coincidence, it will, we are seeing a lot of these inflation reports being skewed by base effects from terrible numbers from 2020 when you go year over year. That will burn off, because you remember last year, March was the crash. April, May, and June were absolute shutdown months. July and August saw a little bit of a recovery. So the July and August 2021 CPI numbers, et cetera, should be real. And the first real indication to the Fed and everyone that inflation is maybe more than transitory. And it also dovetails with the August Fed speech. So I'm really looking at September as a critical date.
No, that's amazing. And we should all look towards September. And I think that's a great overview of inflation and rates. And we'll see what happens. Like you said, in October, we'll really get a good idea. We've been working from home for the last year, really starting in March of last year. So it's now longer than a year. We're trying to get our office reopened. Some of us have been going in 2 or 3 days a week. We're still handling our clients and we're still keeping busy. So let's talk about the office sector. To me, that's the most interesting, because with office, the long-term future is sort of unknown. I go into our building, and it used to be I'd have to park on the 5th floor of our parking structure to find a space. And today, I can park on the first floor
anywhere we want.
Anywhere I want. And so it tells me, even though the roads are crowded, the office building isn't crowded. And so I really wanted to dive into the office sector first, because that's the one that really fascinates me. David, what's your general view? Is it going to be everybody goes back to as normal? Is there going to be some sort of hybrid mode? What happens?
Well, first of all, I want to talk about what we're hearing from CEOs of the big financial companies, the big tech companies, and why they want people back in the office, wanting a full return or a near full return. It's hard to establish or corporate culture and mentorship, especially among the youngest workers, who are the bulk of all workers, because they're at the bottom of the period, the big, the rank and file. So, we've seen Goldman Sachs, Bank of America, JP Morgan, and Google all say we want people back in the office. There's a lot of Zoom burnout, as everyone knows. And also Jamie Dimon, who's a real thought leader, said we lost some business because other banks did in-person meetings. This is, again, pretty breaking news from a couple weeks ago. Jamie, Mr. Dimon said this, about 2 or 3 weeks ago, saying, I've been on Zoom calls. My competition's been flying out and meeting people fully vaccinated in some setting, and maybe an outdoor restaurant or a conference room, and I'm losing the business. I want everyone back in the office. So, yeah, so my last thing is, so what we'll see is, people have become used to working at home. I think there'll be some kind of hybrid model. They say Tuesday and through Thursday are going to be the hot days. Friday might become an optional day. Monday's always been kind of a pipeline day and kind of get the work going. Who knows what Monday will be, but there will be some kind of, some kind of hybrid return to the office. And the question is, how much space will the sector need? I say maybe less than today. I mean, more than today, but less than 2019.
No, that's really interesting. And, I think it's fascinating too with Google, because, here in Los Angeles, they've bought the West Side Pavilion and they're opening a huge office complex. But at the same time, they're telling their employees, you never have to return permanently. So it's interesting with the tech companies where they still are moving forward with their plans to build out these big offices, but they're planning on their people not being there full time. And then we see WeWork's gaining a lot of popularity again. I mean, so it does seem like companies are saying that it's not so much the cost of the office space, it's the productivity that you can get by having a hybrid model. Is that sort of what you think people are saying?
Yes, I do. I think they're gonna feel it out, and they're gonna learn as they go. And I think the next 3 months will be preparing for this fall. Fall has always been a time for back to work. In the pre-COVID days, it was, everyone knows in August, it was impossible to find any investment banker, senior person. They were all in the Hamptons or Palm Springs or things like that. And, Labor Day was always, all right, everyone's back in, everyone's back to work. I think this year that will be especially momentous. And, I would like to, talk about things, so we'll talk about the capital markets in office. Now, compared to retail wears its heart on its sleeve. When you drive it by a retail center, you see the restaurants that are having terrible business or maybe booming with delivery or patios, stores half empty, etc. You talk to landlords and you've got lots of tenants, giving them, asking for COVID relief. Office is much more opaque. Let's just take Goldman Sachs and JP Morgan. Their stock prices and profits are at record highs or absolutely gangbusters, yet they have millions of empty office space that they're paying rent on. So what is the lease term of office? Office is a 10 to 15 year lease, maybe 5 years in more suburban office, and so it will take a while now for maybe now the big landlords the big tenants are deciding this is how much office I need. When is their next lease roll in the next few years? So if you're out there and you're buying an office building or refinancing, lenders and equity are really going to look at your next 3 or 4 years of lease roll and what will those tenants say their office needs are at those points. A lot of office brokers say that when office rents go bad, it takes 3 years for it to hit bottom because, again, they just don't disappear out of the office. Everyone keeps paying, but you're going to start finding out about what tenants really need, and what lenders are going to be looking at are what are the recent expirations and what did you pay for TILC on recent renewals since the pandemic? What are new leases being signed at? What TILC free rent is market now? And what do the next 4 or 5 years of rollover are coming? And then another critical thing that's unique to office is sublease space. You don't see a lot of sublease in retail. You don't see anyone, subleasing apartments or rarely in industrial, because that's such a user market. But office sublease space is huge. It's very trackable. And so if you're buying a property and they say, hey, the market down here in this tech belt is 98, 95% occupied, but you've got 20% of the space leased and on sublease, what's your real occupancy? Because that sublease space often is marketed at a lower rate. You're competing with that, with your space. So, watch the sublease space and have all your, and know your markets.
No, that's great advice, David. That's phenomenal advice. And I agree with you. And I'm on the board of a couple of nonprofits, and they're all looking at, can we sublease our space? And I'm afraid the answer is going to be no, that there's going to be so much sublease space on the market that it's going to be hard to fill it, because the companies that want to be in offices are going to be able to be in offices. There's going to be plenty of space out there, at least in the short term. So it's going to be interesting how it all shakes out. And it's an interesting contrast, because we have industrial and multifamily that has really been a wall of capital, that those have continued to sell. We financed a ton of multifamily properties last year. Lenders stopped doing retail, they stopped doing hotels, but they kept multifamily and industrial because those were such great product types and such a great market. So as we look at multifamily, do you think this continues? Are we going to continue to see this big wall of capital supporting multifamily? And is it going to go more to existing products or to development?
I think that multi is still the preferred asset class. You have, one overhang from the financial crisis that was good was a much stricter underwriting on home mortgages. So let's look at the SFR market. The couple things interesting are happening here that are affecting multi. One is back to the Fed. Super low rates have created a red hot sales market and rocketing prices for single family homes. That's leaving many people out of the affordability belt, unable to afford a home. And so they are renters. And the other issue is a brand new product type, or very new product type, is that came out of the financial crisis, is big portfolios of home for rent. And so not only do we have a supply demand imbalance of single family homes today, because the funds that bought giant pools of foreclosed mortgage homes in 2009 through 12, we all remember that boom, they're still at the table looking for product. The only thing they can buy is when someone's developing attractive homes, oftentimes, instead of the old tradition of having the model house and all the users coming in and slowly buying the homes and creating this neighborhood, you have a fund from Europe or Blackstone or Alliance Bank out of Europe, I'm saying, buying the entire SFR development before it's even finished. And so then again, you have a supply demand, which helps multi.
David, let me cut you off for 1 second. And I just want to harp on this because I think it's so important. And, as a company, I know 2 or 3 of our teams have closed on these build to rent products that are really, I would call them a townhouse or single family home project that's entirely for rent, not for sale. And like you said, these big institutions are doing it. I have a client in Las Vegas who had 2 townhome projects under construction, and both got acquired by one developer that's going to do this build to rent type of structure. Do you think it's going to have an impact on what I call normal multifamily, or is it a totally different product and it's more related to home sales? Like where does it impact the rest of the market?
I mean, I think it's another, I think so many people are crowded out of buying that I think there's still an incredible class of renters. I mean, we didn't want to do too many slides, but I did have a slide that showed multifamily vacancy nationwide is back down to about 5%. I mean, that's a compelling amount, workforce housing is still largely multi. And I think a lot of, a lot of it is driven by the agencies. What are the agencies looking for now? The agencies are looking for, no, I didn't bring the slide up, Brian.
I got up the industrial one for you.
I got the industrial for the next round. Yeah. And so, what the agencies are looking at is affordability, because their mandate is to provide housing for, blue collar America or the working class. So they're really looking at affordability and really pricing down, and agency financing has been phenomenal. Rates in the 3s, sometimes in the 2s, lots of interest only, maybe some COVID reserves, but you get those back in a year. It's still your money. So we're seeing, I think with multi, you're also looking at your markets. Is it urban versus suburban? Urban core multi is hurting a little right now. And again, the homes, or maybe even just suburban, more room, more, garden style than urban style apartments are in vogue. And you're also watching for, what I call the move to markets and the move from markets. And, when we talk about retail, I'll say again, that one thing COVID has done is not much established new trends, but accelerated trends in place. And a lot of people that were thinking about moving to, and we know the places, Boise, Phoenix, Nashville, Austin, etc., Florida, Georgia, suburban Atlanta, are making that decision sooner. And a lot of these Sunbelt and Southwest spaces are benefiting in the multifamily markets, because that's where, if someone's moving into the market, a lot of times they'll go straight to an apartment to kind of figure it out. And maybe some of the urban locations are suffering, but again, maybe some of our contrarian investors will say, now's the opportunity to build urban and bet on the comeback.
Yeah, no, that's fascinating. And the thing that we've seen too, that's been really fascinating to me. I mean, I think just as a company, we've probably adding 2,000 plus units to Boise, Idaho that we're financing.
Right.
And it's the crazy thing. There probably hasn't been that many units built in Boise in the last 10 years. And so incredible to see the growth and the diversity and how capital has moved from market to market. Taking a step back and looking at the big picture, what do multifamily sponsors need to look out for? Like what's the important thing going forward?
You're a multifamily sponsor. You're trying to get ready for a refi or you're buying something. What are lenders looking at? So you need to, they need to understand the tenant eviction moratorium in the place where you're buying. Are rents softening? Are tenants asking for relief? Lenders are looking hard at the last 6 to 12 months of collections and looking hard at bad debt and accounts receivable. In 2019, no one cared about his accounts receivable unless it was a big number. Now, lenders are pouring over ledgers like slow pay tenants, no pay tenants, tenants catching up. And then, we're now seeing with rent softening, and Bryan brought this up, like if you had a vacant unit in an LA area apartment, a lender would just mark that to market because of rent control. It was an opportunity to rent at market. Now, with some softening in some markets, that lender might now be looking at that as just an empty unit, which is what it is. And so you're going to be seeing, you still have great rates available. There's a lot of construction happening, but it's anticipated to not be in an overbuilding mode. So, and so these are the things that, that buyers and, people refinancing are going to have to know to be able to provide to lenders in order to get the best execution.
No, that's great advice. Let's talk about industrial quickly. The industrial market has been so hot that it's hard to get industrial product. I think Amazon and just all the distribution increases that have needed to happen for COVID have really, like you said, accelerated that forward and put us in a position where, that there's still the old retail stores, but maybe they're not as useful. What do you see with industrial? Where do you see that market landing? Is it still a good time to invest, or is that market overheated?
I mean, I think that one of the trends that is accelerated during COVID is the absolute critical logistics chain, and anything warehouses, whether it's the giant warehouses, you see out in the Inland Empire that are at the nodes with the 40-foot clear heights, and they seem to be square miles, down to what's called the last mile piece of it, which are small industrial places in population centers that all, whether it's supply chain for automobiles, et cetera. I mean, I've seen an interesting recent article saying that just-in-time supply that Toyota kind of pioneered in the 70s is now out of favor with the inefficient supply chain. So car makers are now storing more supplies near their factories and need more industrial. So, I mean, I would just say, know your locations, know your markets. There's a lot of opportunities I was on the phone with an equity investor this week that is, building metal buildings, Butler buildings, as we used to call them, in almost the middle of nowhere in the Central Valley, but it is hub and spoke near the giant Amazon and Walmart warehouses. So, maybe it's finding those opportunities is my recommendation. And from what we've seen, the amount of construction is going to be absorbed, but there's always a risk of markets like that overheating.
No, that's very fascinating. And there's a lot more to come, and we go on forever and ever about the industrial market. Let's jump into retail. And in a way, I think they're connected, because part of the reason why industrial is so hot today is it's stealing away that luster from retail because of Amazon and those type of distribution companies. Where do we land with retail? First of all, let's talk about lending on retail. 6 months ago, there really wasn't very many loans unless you were grocery store anchored retail. What's happening today? Are there loans out there for retail properties?
Yes. I mean, lenders are, one good thing about the capital markets is they're forward looking. I mean, they look backwards for history, but so they're looking forward to the reopening, of America, people back in restaurants, another key date, June or July. New York City is going to declare itself fully open for indoor dining. That'll be like a talisman for the rest of the country. So much media will focus on that. And so as retail opens up, we're seeing lenders look at sales, et cetera, and a pretty strong market, a CMBS and some life company for good retail. And I would say, again, we have trends that accelerated. I'll go into kind of winners and losers. The winners are grocery and drugstores are critically important. People are realizing that they're more important than ever during the pandemic. People are going to be getting booster shots for a long time, and Walgreens and CVS, I'm just naming because they're the big two, have become a critical piece of the infrastructure to distribute vaccines, because we don't have an England or Canada style public health system where there's government outposts. We use the private sector, and that's been these drugstores.
And real quick, David, I think that's a really important point, because I think that, we say that retail's out of favor, but one thing we did learn during the COVID crisis is if there's a national emergency, Amazon can't get stuff to us quick enough. You need to be able to drive through. So I always think there's going to be some hybrid model there as well, where, and we're already seeing it. I mean, Amazon has a distribution center. I mean, not Amazon, Walmart has a distribution center out of their stores. Target's starting to do that a little bit. Now they're starting to do I went to the grocery store the other day, and they have a full thing where you just do your order in advance, you drive in and pick it up and leave. That's the future. Are we going to see some type of hybrid mix between distribution?
Yeah, it's like almost like retail becomes industrial now. What's interesting is, retail rents might be $3 a foot in places, and industrial rents are $1 a foot. Just so. But the retail centers are becoming fulfillment centers, places to return. It's called omni-channel, that people like ordering online, but being near a physical site. for Best Buy, et cetera. The big question will be, as these the big ones, the Targets, the Sam's Club, the Walmart, and then even the mid-size, the Best Buys, the Office Maxes, et cetera, could go on to excuse me. So as they thrive and are doing multi-use out of their stores, how much space will they need? And again, it's what borrowers should be looking at. As you have rolling leases in your 10-year term post-COVID, what will Best Buy need? Maybe they'll want half the space. Maybe or maybe they'll need 3/4 of the space, et cetera. So there's going to be a big shakeout. And again, I think that the losers are going to be kind of the big box. There's a lot of apparel that is based on people going back to the office. So we have a tie-in there. So are people going to be back in the office and buying all that apparel, or will apparel stores shrink? Are people buying more clothes online with new 3D imaging where you can try on clothes at home? So those big box apparel are places to watch. And I think that, I've always been a proponent of the absolute daily needs that are at present internet proof. And I'm talking about the nail salon, the cleaners, the picking up of Chinese food, pizza, noodles, whatever it is. And those absolute daily needs are going to shine, and the big boxes, maybe the middle will be a little muddled.
No, that's super interesting. And it is interesting. I mean, we've seen triple net deals stay hot. We've seen grocery store anchored retail stay hot. So it's really more that the big, huge stores, it seems almost like there's not enough of them anymore. Like,
right.
There's, you have Best Buy moves out. Who do you move into their space? There's not another group anymore out there that competes with them.
Right, exactly. And so you have no more Circuit City, REI, Best Buy, and kind of Office Max versus Staples are becoming category killers, which makes them able maybe to dictate terms more,
Yeah.
And so, I mean, I think that's going to be something close to watch,
Yeah,
and so what I would say is, we want to go speak to our sponsors, and I'm doing a lot of retail submissions right now. And what are lenders asking if you're trying to do a retail refinance, or if you're buying retail, what should you be looking at? And it's all about documenting the COVID status. Who got rent forgiveness, deferral, what's the status of the payback? Store sales and trends are more important than ever. Are any spaces being repurposed? And you really got to watch your rollover, because it's just like office. In the post-pandemic world, what retailers decide they need may be different than what they did from 2016 to 2019. So I think, and it's the classic question: how much are renewals going to cost? How long is stuff going to remain on the market? And what kind of TILC are tenants expecting?
No, that's really interesting. And I'm going to take a little break from our topics real quick, because we're starting to get some questions on the multifamily side. One of our listeners is asking about Fannie and Freddie lowering their cap this year. Do you think that's going to have an impact on multifamily? Do you think they're going to get too full and it's going to change the dynamics of the multifamily market?
I mean, I think, they're under conservatorship. These cap limits make the affordability, if you're what's called mission rich, and it means that the majority of your tenants are what they're earning allows them to easily afford your units. It doesn't mean anything about deed restrictions. So affordability in workforce housing is going to go to the front of the line. Maybe the high end is going to be a little tougher to finance. You might have to go to CMBS or banks, but you still have the life companies and CMBS that are very hungry for multi, and maybe won't be as clean of an execution as Fannie and Freddie, but I think there'll be plenty of financing even when they hit their caps.
No, that's really interesting. And one of the other listeners is asking about HUD financing. I mean, I have pretty sharp views about HUD financing that, for certain product types like skilled nursing and very specialized products, it's a great option. And for construction in some markets where a family is building, but everybody's attracted to HUD because of the low rates, loans, but it takes a year plus to do any HUD loan. So do you see HUD having any major impact on the market, or is it going to remain where it is as sort of a novelty for owners?
Yeah, I think it's going to be a novelty for owners. There's a lot of things about HUD, the twice a year distributions, the high reserves, where it works for some product and not others. And so I think I don't see HUD taking a huge amount of market share more than they have.
No, and as we start to run out of time, I wanted to, we have a whole hotel segment planned, but I think we're going to cut it a little bit short.
Yes.
Just takeaways on the hotel side that you want people to be aware of. I mean, my biggest takeaway, I have clients that have had, probably 3 or 4 clients that are in special servicing on hotels. And it's been a very tough time where, hotels went from doing very well overnight to doing nothing. And really no fault of the owner, no fault of the operator. It's just that happened, COVID happened, and it changed the world. Are hotels going to rebound, and what's the future look like?
I think it's going to be selective. I think there's huge pent-up demand for, experiences, drive-to experiences for families, and leisure travel, transient travel. The real tough thing to predict, and I call this the last piece of the puzzle, will be conventions and business travel. I mean, you won't see that till 2022, 2023 come back. So that hotel that's attached to a convention center and only exists for a conventioneer that's not near anything special might suffer. But we have, but there's going to be a lot of demand for resorts. And, I'm in a big family. 3 of my cousins have kids who adult children who have put weddings off, and all 3 of those weddings are now planned for 2022. And I've talked to some of them about it. They say that when they're talking to their wedding planners, that there is huge demand for wedding venues in 2022, spring, summer, that you're going to see lots of leisure travel, pent up demand. But, the business and kind of the business convention travel, those destinations are going to suffer a little. I've also seen a lot of faith in extended stay. I have that slide. Barry Sternlicht, and Blackstone just bought extended stay. This shows, for $6 billion. This is last month. This was not a distressed sale. Extended Stay America, their occupancy throughout 2020 was 74%. So, certain sectors, extended stay is almost benefiting from the pandemic. People are displaced, they need a place to work and to live temporarily for whatever reason. They are flocking to these hotels. So it's very individual, but I would also say that delinquency rates are finally going down.
No, that's great. That's amazing. And I think something too on the hotel sector that is very interesting trend, and where hotels are hard to finance today, there are people now converting hotels, especially extended stay hotels that aren't doing well, can be converted to multifamily very easily. And we're seeing that as a trend. And we've seen, I think we have 4 or 5 of those deals in process right now. Are you seeing that as well?
Yes, I'm seeing that. And I'm working with a client in the Pacific Northwest that is buying, older motels and hotels. There's a huge housing shortage up there. Again, Oregon and Washington, a lot of it is, like the Boise effect, is a move to market. And they are converting these small units as fast as they can because companies are hiring and there's no housing. Part of it's due to the recent fires up there, but it's still a very active product type in the right markets. Is kind of this micro housing in a converted motel room that has all the amenities of an apartment.
No, that's so interesting. And I think, in the future, we're going to have to do this on a regular basis to keep people updated on what's happening in the market. I think it's
Yes.
very interesting. Let's talk a little bit about the future. Where do we go from here? I know you had a couple of slides, so I'll bring those up.
Yeah. So here's, this is something, we wanted to close with, talk about what are we looking at in the future. So we're talking about investing. This is investing in the 80s. This is a 19, it's how we invested in the 80s, looking at stock tables. Now we're investing with Dogecoin, and people are investing based on memes, or they're in on the joke, or they're investing Saturday night at 2 a.m. and Monday morning at 9 a.m. And I think Dogecoin is just symbolic of all this. And also the Reddit rush to buy GameStop, meaning, people are investing for different motivations than just the old P&E. They're doing it out of almost a social movement. They're doing it to say they're in on the joke, or they like the dog and they like showing friends that they're buying it on Twitter. And, maybe it's, very millennial based, but what with Doge and all this happening, what is the future of real estate investing? What are the future trends in real estate? And so we're talking about, cryptocurrency. We've heard anecdotal word like Caruso Properties, that runs the Grove here, is accepting rents in cryptocurrency. Does that mean they convert them immediately to dollars? We're Excel geeks here. Does that mean we enter cryptocurrency in the P&L, in the op statement?
I hope not. I hope we don't have to do that.
And then have to do a little conversion factor. Another thing, the growth of crowdfunding. We remember Tenants in Common in the early 2000s. Is crowdfunding the new TIC? Is it gonna, are people, this is a little bit like the Dogecoin thing. People love to buy hotels at the beginning so they could go to the hotel and say, hey, I'm a part owner. And now it's getting more sophisticated. Multifamily and industrial are really benefiting. I've been involved in a couple arrangements of those types of things.
No, that's so interesting. And David, I can't thank you enough. I feel like I had the honor of sharing your brain with the entire world today. And I think.
Thank you, Bryan. I just try to do what I would always say is that I'm not really the economist. I was writing and editing our newsletter with our late chairman, George Smith. I learned everything about his writing style. And, after he passed away, I continued to write his column. I've been lucky enough to have learned from him and then been in this place for 30 years almost, and just, talking to every capital markets guru from, I've learned from all of them. So it's been a great time.
No, I thank you so much. I want to thank all of our listeners. And as we said, the market is constantly changing, but it does look like, inflation isn't going to get crazy. Rates, we're going to have to take some time and see what happens in the market. And we think they're only going to go up if the economy gets better. So I think overall, it's all good news. It seems like where last year was all bad news, this year seems all good news. Do you agree?
Yes. I think it's going to be good news, but a little bit lumpy, and not like a booming economy of the past. It's going to be a unique recovery. And I want to remind, again, speaking to our sponsors, we all know real estate's about opportunity and timing. And so our sponsors were in this unprecedented cycle, and the choices that you make in the next year or two, we want to be there to help you fulfill your vision and get your property financed. And for you to provide, we look to our sponsors to be smarter than both of us, Bryan. It's to know where to buy and when to refi and when to sell.
No, I'm not only learning from you every day, but I'm learning from them as well. And even after 30 years in the business, it seems like there's always something new to learn. So thank you so much. Thanks everybody.
Thanks everyone.
And come back for our next Finance Friday. Thank you so much.
Yes, thanks.